You're listening to the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.
This is the Options Industry Council's Wide World of Options. Before we start today's show, investors should know that options involve risk and are not suitable for all investors. You should not enter into an options transaction until you have read and understood the risk disclosure document, characteristics and risks of standardized options. This brochure is available by visiting www.optionseducation.org or by calling 1-888-OPTIONS. OIC makes no recommendation with respect to any financial firm. OIC does not make any warranty as to the accuracy, usefulness, timeliness, or the continued availability or existence of information created or maintained by others. Multiple leg strategies involve multiple commission charges. Opinions and strategies expressed by others are not necessarily those of OIC, nor does OIC endorse, warrant, or guarantee products, services, or information described or offered by such firms. Commissions, fees, margins, interest, and taxes have not been included in any of the examples used in this show. These costs impact the outcome of all stock and options transactions. Consult your tax advisor about any potential consequences. None of the information presented in this show should be construed as a recommendation to buy or sell a security or to provide investment advice. Welcome to the Options Industry Council's Wide World of Options. OIC was created in 1992 to educate investors and their financial advisors about the benefits and risks of exchange-traded equity options. OIC offers a variety of resources to those interested in learning more about options, including live seminars, webcasts, and podcasts. Check out www.optionseducation.org for more information. Now here's your host, OIC's Director of Retail Education, Joe Burgoyne.
Today's program is a rebroadcast from OIC's webinar program. Every month, we do webinars on a variety of options-related topics. Check out optionseducation.org for more information. Enjoy the show.
Good afternoon, ladies and gentlemen. We're going to get started. We're glad you could join us for the latest installment of the Options Industry Council's webinar series. My name is Alexander, and I'm a staff member here at the OIC. I'll be guiding you through today's webinar. How do you know when to hedge? I'm pleased to welcome our moderator today, Mark Benzaquen, who is an integral instructor for OIC, providing investors with the core teachings essential for options investing. Mark is a senior investor specialist for the OCC. He is responsible for providing support to a comprehensive options resource center that provides information and education about options and supports all products traded on all OCC participant exchanges. Mark began his career in options with Stafford Trading before transitioning to brokerage operations. But Mark spent most of his career in the trading pit, gaining special insight into customer order flow and trade execution. And now, ladies and gentlemen, Mark will bring you our topic today. How do you know when to hedge? Mark?
Hi, Alex, and thank you for that introduction. Ladies and gentlemen, thank you for joining us today. Boy, what a couple days in the market, huh? We had a little bit of a bloodbath yesterday, great buying opportunity today, it appears, and I know that we're going to talk to our two presenters, our two panelists about that today. But before we get to that, let's go ahead and cover our disclaimers. As we all know, options involve risks and may not be suitable for everybody. As a matter of fact, in order to trade your account, it needs to be approved to trade options, and part of that approval process is the receipt and acknowledgement of the characteristics and risks of standardized options booklet. You can get a copy by contacting OIC or your broker. Also, some of the concepts that we're going to be talking today are simply for educational and informational purposes and not intended as a recommendation or solicitation. Speaking of volume, boy, look at what we've had these last several years. Really a big explosion since 2000. A lot of that we feel is obviously through electronic trading, and ETFs have been a big part of that, but also options education. Speaking of OIC, we also have these options exchanges that we support. You can see the 5 different exchanges that own the 15 various regional exchanges. But all of that is fun and good, but in terms of our presenters today, we're very, very fortunate to welcome 2 of the greatest, Joe Mazzola, Managing Director of Education from Schwab, and Dan Sheridan, the CEO and founder of Sheridan Options Mentoring. Before we get to the presentation, guys, how about you say hello and introduce yourselves briefly. Joe?
Hey, thank you so much for having me today, Mark, and everybody out there. My name is Joe Mazzola. I've been in the business about 20 years. Originally was on the CBOE floor as a market maker, and then I've kind of been in the brokerage business ever since. And now my job with Schwab is we create and facilitate investor education, and a lot of what I do is on the derivatives and the options side. So hopefully that's a little bit relevant for what we're going to be talking about today. And I think that, as you mentioned before, Mark, we're in an environment where hedging is probably top of the list for many of our viewers today in terms of what at least they're thinking about. So that's kind of my background, and I'll turn it over to you, Dan.
Oh, thanks, Joe, and thanks, Mark, for having me. Welcome, everybody. As Mark said, what an incredible timing. I think Mark gets the MVP award for Joe, whoever scheduled this, for hedging on this day, where you have absolutely pandemonium in the market. But anyway, my background, I was at the CBOE as a trader from 1982 probably through 2004. About 22 years. I worked mostly with a specialist trading firm, Mercury Trading, and worked mostly with the Nigerian brothers who are in CNBC Fast Money. Basically, that's what I worked with most of the time, John and Pete. And the last, let's see, what does that leave? About 14 years, I've been trying to teach retail traders how to bring in a little bit of extra income every month trading options. So that's been fun, going from the pits for 22 years, 23 years, and then working with the retail public. And so glad to be here today. Mark, did you want us to give a few cents on the markets, or did you?
Well, yeah, again, I just want to thank both of you for joining us. Before we get to the presentation, let's just go ahead and look at what we're going to be talking about today. First and foremost, hedging questions. And boy, Dan, as you had mentioned, what an opportune moment to have this presentation with what happened with the market yesterday versus what's happening today and versus what may be on the horizon. So, hedging, I think, should be, or very likely is already, at the forefront of everybody's minds in terms of how they can protect themselves. And how they can protect themselves are some of the things that we're going to talk about today, with protected puts, using covered calls, for example, using a collar. And I already see a bunch of questions coming in, so we will try to leave some time for Q&A at the end. But before we get into what is hedging, guys, let's go ahead and just talk about that market a little bit. Yesterday was a bloodbath. NASDAQ down 350 plus. I was a NASDAQ broker for many years. And when we had a down day of 100, people were running from the hills. I can only imagine what it was like yesterday down there on that floor. What do you think? I mean, in terms of hedging, boy, is there anything else that people should be talking about today? Dan, what do you think?
Well, I think the biggest thing that I've noticed, at least dealing with retail traders, is the downside is different. We've had a honeymoon here, in my opinion, for the last 7-8 years. Been in a low volatility environment, and the market just gone up. And 2000, a big bull run. And 2008 is the first time we've had something a little bit more sustained downside. Every other time in 2017 or 16, the market starts going down 4%. It's a big joke, and it comes back, right? So there's no fear, right? And especially with long portfolio strategies, your cash secured put covered, right? It's like blind squirrels on roller skates could have made money most of the last 6-7 years. Market never goes down. And this year, it's the boy that cried wolf. We've had almost 3 corrections this year. One in February of 10%. In March was maybe 5 or 6%. And yesterday in the SPX, as of the lows yesterday, was, whatever that was. From the highs a month ago of 29.40, we were about 9%, I don't know if we hit 10% down, but Russell easily corrected. It's been down way over 9%. So now the boy has cried wolf and the market's going down. And the biggest thing that I see is people where they get wigged out on the downside is it's different, right? If you look at the last 5 months, for 5 months, from May through October, 5 months it took to go up about 240 points. In less than a month, we took care of that, right? That's so what took 5 months to do on the upside, the downside is fast, big price candles. It's furious. And the other thing on the downside is, and Joe deals with this with Charles Schwab, I'd like to get his opinion on this, but execution is much more difficult. And you say, what does that mean? If you're doing spreads and you look at the mid prices of a spread, you can have a dollar range. It's all over the map. So execution's a little fuzzier on the downside. It's a different animal trading the downside. Now, with that being said, I think it's pretty normal, right? The market's been up. This isn't unusual at all. And I think we'll stay volatile like this minimum through Thanksgiving. And these big red candles will eventually slow down. But I don't think it's necessary. It's way too early to know if it's over yet, right? But right now, I think the big theme is, I call this the battle of 2,700. And that's what's been going on lately, right? Yesterday, whoever was fighting this battle, it went under 2,700 to about 2,650. Today it comes back over. So it seems like there's a lot of fighting going on there, but I just think it's, people have been used to the upside and has certain characteristics, easy to get execution, and then you get this just vacuum on the downside. It's a lot for people to fathom, and for a lot of people who've been doing covered rights, cash secured puts, a lot of these bullish strategies the last 4 or 5 years and thought they developed their own annuity, right? There's a little reality coming in, and I think that's why it would be good to talk about hedging today.
Right, yeah, and you had mentioned fear, and Joe, this is something that we were talking about before the call. You had said, look, the VIX didn't even hit 30. What are your thoughts on the fear of how things are going now?
Well, I think there's a couple things at play here. So, number one, Dan, this is kind of touching on your point of the volatility selling plays that we saw, in vogue for basically, 3 or 4 years, really up until January and February when they kind of started to explode. Basically, people were selling vol, selling options, willing to sell basically a 10 or 11 VIX with the idea that, the realized volatility was going to be cheaper than the implied volatility. They were going to sell an implied volatility for, 10 or 11, and the realized is going to be cheaper, and they're just going to continue to roll and do that month after month for the income generating strategy. And for, that works until it doesn't. And when it didn't work in February, when you saw this huge spike in the VIX, we traded north of 40. I think at one point the high that we hit was somewhere around like 48, 49.
Right.
Beginning of February, before we pulled back in the VIX, and then the market, the S&P kind of corrected itself and found some positive footing again. But I think, I don't want to say this time's different, but I do want to highlight a couple things that at least are causing a little concern on my end. And you mentioned one of those things, Mark, is the fact that the VIX yesterday, on a day where, we basically pushed down below the 2,700 level that you had mentioned, Dan, basically 2650, 2655, I believe was, maybe the intraday low. But, the high of the VIX at that point was 26.5. Now, if you go back to, not even all the way back to February, but let's say we just go back 2 weeks, okay, just 2 weeks to October 11th, when the last time we saw the VIX approaching 30. Basically, at that time, you saw the S&P trade down to a 2710 low, with the VIX trading 29. So let's just kind of think about that. So yesterday we pushed below our October 11th S&P lows. We set a new low, at least for the month, right? At least for the month or the short term. So we set a new low, basically 60 points below where we traded October 11th. However, the VIX didn't touch that October 11th high. So that inverse relationship between the VIX and the S&P 500 or the SPX, where you would think, if we're setting a new low for the month, or at least for the near term, you would think that the VIX would have traded up above the level that we saw on October 11th, and it didn't. And what that says to me, and this is why I'm a little bit more cautious, is that I think looking at that, I think a lot of the hedging on the institutional side probably already done. And so I think a lot of the institutions were a little bit more prepared for the downdraft, and I think a lot of the downdraft you saw yesterday was a lot of retail selling. I think it was some technical selling. I think it was some retail selling. And when I see something like that, and I don't see the corresponding big bounce. Now, granted, the S&P was up basically 50 points today, but I just didn't see enough movement in terms of the VIX. I guess the term that we talk about, the blood on the streets. I didn't see the blood on the streets yesterday like I was kind of hoping to see that would say, hey, this is a true washout. Like this is it. This is a bottom. I think, and I think what's really relevant about what we're going to talk about today is because I honestly think you're going to get another chance for a hedge. For people, I guarantee there's people on the call right now that are like, well, we already missed the hedge, right? I mean, it's over. We already missed the hedge. And I don't think that that's necessarily the case. I can't tell you for sure, but I don't think that that's necessarily the case. I think we're going to get another shot for a hedge. And what I really think that your viewers and our listeners can take from today is, how am I going to be prepared, if we do start ratcheting back up in the market, getting back to some of those levels that, maybe not the same levels that we saw at the beginning of the month, but, maybe we start getting back to some of these moving averages that you want to keep your eye on, at least in the S&P. You got the 200 is right at basically 2767. I mean, we're quite a bit below that. So let's say we get back up to that level and we fail. So if we get back up to that level and we fail, you're going to get a chance to throw some more of these hedges back on. So, one of the takeaways that I would say from today's conversation is, even if you feel like you missed the boat to hedge your positions before, you might get another chance. So be ready. Take what you can from today's conversation, learn some of the tricks of the trade, and then be ready for the next time.
Well, and what I like about what both you and Dan had said, Dan had used the phrase that these people have been selling options over and over and over, and basically writing their own annuities, which I think is terrific. And then also, Joe, you had mentioned, and it's something I'm familiar with from the floor, that you keep doing what you're doing, it keeps working and working until it doesn't. And it's until it doesn't, that's usually where we get into trouble. So let's go ahead and start out at step one. And Dan, maybe you can help us with this. So last week we had Marty Kearney on and was talking about risk management. So we were talking about managing risk with options, and he was looking at several different strategies. But let's first begin more generally, and let's talk about, when we're talking about hedging, what exactly is it that we talk about? What do we mean when we're talking about hedging? What exactly is a hedge?
Okay, I was going to cheat and look in the dictionary and see what does the word hedge mean, but I would. I didn't get enough
about what
time
does it
to do
mean
that.
to you?
What does it? Yeah. Oh, I know. What does it mean to me? One word, if I had to say, in some form, protection. But I'm going to give two quick examples. So, I think, 1 month ago, let's face it, about a month ago, SPX was around 2940. Some of the highest levels in the history of the United States of America, right? So anybody, I'm sure at Schwab, where Joe is, or anybody anywhere, had to be thinking, hey, I've owned this stock, I've made 20% a year for 3 years, let me pinch myself, right? And so they were thinking of this thing, hey, maybe I need some protection. Maybe I need a hedge. Option volatilities are very, very low. VIX, when we were 2940, is very, very low, 9, 10, 11, 12, whatever it was. Hey, should I buy a put? Should I get some protection against my stock to somehow take some money off the table? That's one way. Hedge a position maybe you have. Hedge a long stock position. How I look at hedging more, and I think that's your classic way of hedging, I look at hedging as, hey, I do a lot of income trades. range-bound trades for weekly and monthly incomes. I put them on every stinking week. You know, calendars, iron condors, butterflies, some of these types of trades. Those are some of the trades I trade. Well, how is that hedging? Well, if I do an iron condor, which is a range-bound trade, I do an out-of-the-money call credit spread, out-of-the-money put credit spread, the foundation of an iron condor is a short strangle. All right? You know, so in other words, the main reason I hedge, I don't want to hedge. I'm selling an out-of-the-money call and put because I think they're going to decay. And if I sell them far enough out, I have probabilities. Now, obviously, I'm going to have a good risk management system there, but I can't just do the naked options because my return on my investment will be horrible. I'm going to have to put up half the money in Chicago to do that. So what do? I buy some further out of the money puts to hedge my short options. So it doesn't just have to be protection when I bought stock, it's run up for 42 years, and now I want to somehow hedge, right? It can be, hey, I'm trying to bring in weekly income, but I need to hedge to get a better return on my money. I can't stink and sell naked options, right? You can sell naked options, but I generally don't want to do that because it's going to hurt my return, eat up a lot of capital. Now, we'll talk in a little bit how you can even hedge today, even with, SPX down 8%, Russell down over. You can even hedge today, even if we don't rally back up to the 200-day moving average or whatever. I think there's some very good hedges today, and we can talk about some. But that's what comes to my mind. Hedging, it's not just hedging long positions. You can hedge other positions. An iron condor, the foundation is a short strangle. Iron butterfly, the foundation is a short straddle. Well, you can't be doing short options unless you have more money than, Bill Gates. So you need to do those hedges. Anyways, that's a few thoughts on hedging.
Okay, so Joe, let's look at it this way. I remember from my days on the floor, I was a pit broker on the NASDAQ for more than a decade, and every time I would do a trade or execute a trade on behalf of a client, let's say I'd be buying calls, for example, every trader on my ticket, the ones that sold the call to me, they would turn around and buy futures, or, if I was doing something in the equities, they would buy shares, or they would turn around and simply make another trade to flatten or hedge their risk. Is that what we're talking about here, hedging risk?
A little bit. So basically what you're talking about is kind of like floor trading, right? So, you buy 100 calls and you short shares against it as a way to kind of lock in the edge that you've collected on that trade. So basically, if you think a call is worth $1 and somebody's willing to sell it to you at 90 cents, well, you pay 90 cents and then you short shares against it. You try to lock in that dime edge, and you have a directionless, right? So a directionless type of trade where basically you're betting on the volatility as opposed to, the movement of the underlying. Well, here's the issue with that. I mean, basically, if you have to short shares, and that's a very margin-intensive type strategy, and for most retail clients or most people in general, that's a very expensive type of trade. So we don't do that outside of floor trading for the most part. I mean, there's still, of course, are many prop trading firms or hedge funds that'll do things like that. But basically, that's kind of not what we're looking at today. What we're looking at is how do you protect your long assets? And the majority of our listeners today, I mean, that's why they're here. They see what's going on in the market, and they say, there's something that I'm trying to protect. There's an asset that I'm trying to protect. I'll give you a personal story right now. I'm in the middle of purchasing a new house, so I have to make sure that my debt to equity ratio stays at a certain level, and as the market pulls back, my equity goes down, right? So I got to lock in some of that equity. So for me, using buying puts as a hedge, makes sense, because basically what that does is that puts a floor in the market that says that the market can drop X percent, and at some point my equity level will maintain a certain level because of that floor, because of that hedge that I've created. That's really, I think, what we're looking at. And Dan, what you're talking about with the iron condors and iron butterflies, Yeah, those are hedges, because what you're doing is you're hedging your short options. Basically, you've created a risk-defined type trade, and you're doing that in a manner of where you're actually getting paid, right? You're actually getting paid to create this type of position, right. Whereas traditionally buying protective puts, you're going to have to pay for that. So it's really,
right.
You talked about the whole idea of the annuity, right? I mean, insurance companies, they sell you the annuity or they sell you the insurance product. And it's similar to kind of what you're talking about is they say, well, if we have enough of these premiums that we've collected from selling these insurance products, or in your case, enough of these spreads that you've sold to collect the premiums, what that does is it widens out, gives you a little bit more cushion against big moves because you have basically, I call it kind of like a landing strip. You have a landing strip where you can land that plane, and the more premium you're collecting, the wider that landing strip becomes, and it gives you a little bit more cushion as opposed to, buying an insurance policy or buying a protective put, where we do that every 6 months with our autos, right? You pay money for your auto insurance or your home insurance. You don't want your home to burn down, but if it does, you want to make sure that you can recoup the value of that home.
Right.
Okay, yeah, that all makes sense. So we talked about what is hedging, and we actually got a little bit also into why do we hedge. It's not that we want to maintain a flat position. We certainly want to maintain our market bias, but we're kind of looking to, cover ourselves, should things go south. So let's go ahead and move into the next section. Now, you guys had talked a little bit about condors and protective puts and stuff, and we're going to get into that in just a moment, the long versus short. How do we know? Do we want to buy options to hedge? Do we want to sell? But first, what I want to do, if you don't mind, and Dan, let's go ahead and talk with you first. Let's go ahead and look at how do we hedge. So, for example, when it comes to putting on the hedge, for me, the first thing that pops into my head is something that Marty spoke of last week, and that was that protective put, right? The insurance policy that, Joe had just mentioned. If it's at the end of your policy and you didn't crash your car, well, you're certainly not going to be expensive. You're not going to be upset that you paid the expense but didn't get anything for it. And, one of the things I was speaking with a caller earlier on the day about the protective put was, the insurance policy that, the most important things that we have in our lives. We've got our lives and our health. We've got our homes. We've got our cars. We have insurance on all of those things. But a lot of people don't have insurance on their portfolio. So that's kind of what we're talking about here, I'm guessing, right? Hedging. One of the things that I first think about is that protective put. Dan, would you mind walking us through the protective put and what your thoughts are on that?
Yes, and again, I'd like to start with a bad analogy if I can, versus a good analogy, but as always. But when you think about, and I'm guilty of this, so this is a personal one. When you think, I live in Chicago, and Chicago's similar to the East Coast, you get a lot of snow, and I never even think about, I wouldn't even think about getting one of those snow plows or whatever, that people have. But in February, snow blowers. What did I say? Snow plows. Yeah, thank you for helping me.
You're telling me, Dan, I lived in Chicago 50 years. You telling me you don't own a snow blower?
I don't. And it's not for a good reason. It's not for a good reason. But, it's. I always say, you know what? The trader in me says, I'm going to go in April to the True Value and I'm going to buy one, right? For cheap. And I never do, of course. But in February, when my back is hurting and there's 13 inches, if someone comes by and says, hey, can I do your thing for you? $200, whatever. I know I'm joking. That's a high number. There's no number, right? There's no, whatever. And if I had to go in a True Value, $500, I'll buy them, and that's not the way to do it, right? It's not, in the pit, there was a saying, buy when you can and not when you have to. And to go into this area of protective puts, one thing we talked a lot in our community, especially, over the last 6 months as the market's rising up, no one knew where the top was, but when we were at 29.40 at that level, volatility is very low. It was, a lot of people were taking some of their money off the table. And one way they do it with a protective put. A protective put, buying a put against 100 shares of stock is simply a long call, right? That's all it is. It's the same graph as a long call. So you'd say synthetically, a protective put is a long call. So what does that mean? It means that if someone's long, SPY or long Amazon when the market's near all-time highs, or you're long SPY when SPX is 2940, and you replace your long stock with a lot less capital, a long call, and you do that by buying a put. But you're still long, right? You're basically saying with a long put, hey, I'm still a bit optimistic, but we're at either this 8th or 9th inning, one out, and hey, I'm not sure how long this ball game's going to go, but I need to get a little bit of protection. So a long put definitely reduces your risk on the downside. It doesn't eliminate it, but you're basically taking some chips off the table. Anyways, apologize for going too long there, but.
No, quite all right. So, Joe, what Dan is saying is with volatility levels where they are, and this is something that we're going to get into a little bit later, buying versus selling. With volatility levels where they are, maybe it makes sense to sell options rather than buy. He talked about the covered call, which, to me, typically, I've given dozens of, presentations on covered calls where we focus on selling out of the money calls for an income generator, right, to get a little extra income off of the shares we own. What Dan is saying, and if you could expound on this a little bit, Joe, is selling in the money calls as a means to a hedge. And I know you were talking about that a little bit earlier too. Is there something that you want to add to what Dan had spoken about?
Sure. I mean, absolutely. And with the in-the-money calls, basically what you're doing is you're getting paid as opposed to paying out, right? And so by selling an in-the-money call, you're going to get more premium because the closer you are to at the money, or actually more in the money, meaning it's above a 50 delta, so a 60 delta, 70 delta. For example, if the stock is trading $100 and you sell the $95 call, that call might have a delta somewhere along 65, 70, depending upon kind of what the volatility is. But somebody's going to pay you more money for an in-the-money option than they would for an out-of-the-money option because it's got a higher probability of staying in the money. So if you're able to sell that option and collect that premium, basically what happens is if that stock drops and continues to drop, you have, I don't want to say protection, but you have a cushion, from down to about 95, right? Because anywhere below 95, that option is no longer going to be in money, and basically they're not going to exercise it at that point. I think it's a good strategy, especially in this environment where implied volatility, or just volatility in general, is elevated because you're getting paid more, getting a little bit more bang for your buck. So, one of the questions I think that a lot of the viewers might be asking is, well, how do I determine when it's better to sell options versus buy options? Well, when implied volatility is elevated like it is right now, that's when you want to start selling options because you're getting a little bit, you're getting paid more for the risks that you're taking. The one thing I do want to throw a little bit of caution on is this idea that if you're doing this on some stocks that you own that are dividend-paying stocks, you have a low cost basis on those stocks. You need to be mindful of the fact that once that call option's in the money, that option could become an assignment candidate. So if you don't want to lose those shares of stock, that might be something that you need to be mindful of, is because the day before that stock's going to go ex-dividend, that call, if the time premium, right? If the time premium, you have the two values of the option, right? You have the intrinsic value and the extrinsic value. So the intrinsic value means how much is in the money. So if I have a $100 stock and I have a $95 call, well, it's $5 in the money. So if the option is trading at $6, that means $5 of it is that intrinsic value. The other $1 is that extrinsic value, or that time value. So that's what I really need to keep an eye on, is that time value. It's that time value that's giving you that little bit of a cushion as well. So with that time value, if the dividend that's about to get paid, that quarterly dividend or whatever it might be, if that amount is greater than that $1, and you don't want to lose those shares, well, you need to take action on that prior to that ex-dividend date, or that those shares could be called away. So in a previous life, what we did, what I did as a portfolio manager with a company that specialized in option overlays, was we had to be very mindful of those, because we had a lot of clients that a lot of their net worth would be tied up in one stock. They were former employees, executives, whatever it be. And so that those shares represented a big chunk of their net worth, and they might have very low cost basis on those shares. And so, we would write calls as a way to kind of generate an income flow for them for those shares, especially if they couldn't sell those shares. We had to be, like I said, very mindful of those ex-dividend days and when those options went in the money. So I think it's a good strategy, especially given the elevation and implied volatility that we're seeing right now. Just be mindful of the fact that if you don't want to lose those shares, go ahead, find out when your ex-dividend date is, circle it on your calendar, put a big red star next to it, whatever you need to do, just to remind yourself that you might need to take action on that the day before it goes ex-dividend.
Well, and you're absolutely right. One of the calls that we get, a covered call obviously is a very, very popular strategy. And a lot of times the investors that we talk to, they just like you had mentioned, they're very nervous about getting assigned. And assignment is almost intrinsic to the covered call strategy. And it also means to me that your the plan that you had, that it came to fruition, right? The strategy is to generate additional income or some protection, but the idea being is that whatever your plan was, it came true. Just like you said, you won the lottery, and that was your end goal. But when it comes to the covered call, the selling in the money calls, what would we do? If you're saying if you don't want to get assigned, you're talking about buying the option back, rolling it out. Is there a rule of thumb, and we're kind of going off script here, I hope you guys don't mind, is there a rule of thumb? How much more time do you look at? What strike, how far out do you go? What do you guys look at personally as option pros? How do you roll that position to manage it? Joe, how about you?
Well, yeah, go ahead, Joe.
So I'm sorry, are you saying in the money calls or just cover calls in general?
Well, either. We're talking about in the money calls, here for protection. So, let's say you did sell the in the money call, and likely it's going to get assigned, but now you have second thoughts. How do you manage that?
So basically, what I would do, and this is kind of what we did my prior professional life, is we would look for a row where we could collect another credit. I'm not a huge fan of rolling out and paying a debit to do so, because basically I look at it this way. I am buying myself an extra 60 days of time, and I'm paying for the ability for myself to cut myself off at the knees, right? Basically what I'm doing is I'm paying somebody to give me the right to not appreciate any more upside. So if I'm not willing to let that thing go, then let's say it's $2 in the money now, and if I can roll it so it's $1 in the money, or if I can roll it so it's an at-the-money option, and I can do it for a small credit or even money, then I think that makes sense. But if I have to pay a debit to extend my risk on this trade, then at that point it's kind of defeated the whole purpose of taking that in as an income strategy. Now, selling. I wouldn't necessarily say that selling a deep in the money call is an income strategy. It can be, right? Because as long as it has some time premium, you are getting some income for it. But if your goal was to give yourself a downside cushion, you get that pullback on the stock, and now this option's out of the money. If it's done its job, and you've gotten that cushion like you were hoping for, and maybe you've pulled back to a level where you think might be a bounce level in the stock, buy that option back. Wait for it to rally up, wait for the stock to rally back, and then look for a more fortuitous opportunity to sell that option again. If you don't want to try to, to kind of time it like that, then what I would say is your next roll, meaning you buy that one option back and sell the next one, your next roll should be something for either even money or a small credit, giving yourself a little bit more room to the upside. Now, that's if you don't want to lose the stock. Some people might say, hey, it's a stock. It doesn't love me, and I don't love it. So if they take it away from me, so be it. That's not the end of the world. The only time, like I said, that I say be hyper vigilant about that is if this is something that you've got from a really low cost basis, and you've determined in your plan, with your financial advisor, whoever that might be, that like maybe this is not the year that you want to pay the extra tax gain, or you don't have losses that you can write off against it. Then you need to be a little bit hyper vigilant in terms of being mindful of that.
Okay.
And if I could add to that just a second.
Yeah, Dan.
Oh yeah, and the only and I agree with everything. What Joe is saying. My only thought is I think it gets back to the basics of when we're talking about covered rights. Let's go back about 14 steps and say, what the heck are you putting covered rights on for? What's your goal? That's going to drive everything, right? What's your plan? If now you could say, well, my goal is income. Well, and they might say, hey, I'm doing covered rights because I like this stock over time. So I like this for the next 4 or 5 years, unless something fundamentally happens, not the market taking normal corrections like it's doing, but I'm taking a bullish stance in the stock, right? Now, so my opinion starting off is, hey, I like XYZ over the next 4 years. I'm in. In other words, right now the volatilities are higher. I'm nervous. I'm ready to move to Switzerland because the world's going to end. That's how we all feel on the downside. So, I want some more downside protection. So I'm going to sell some calls. But if we start rallying, okay, and the volatility comes out of the market, now I get another decision, right? As the time premium comes out, I get a decision to roll. Where do I roll that to? And part of where I roll it to is, well, what's my thoughts here, right? If the stock if the reason I was doing the in the money is more protection on the downside, if I really like the stock, I may roll it up. I may actually pay, Joe, please excuse me for this. I may do it and for a debit possibly. It depends. I may roll it and sell more out of the money if I'm more bullish, right? It all depends if I'm taking a very, very long-term view. So I think you have to get what's your interest in this at the beginning. So there's a lot of thoughts, there's a lot of discussion that has to go into what are you thinking, right, on this bullish strategy. A lot of different thoughts. Anyways.
Right, and you bring up a good point, and that's going to help us segue into the next section here. Anytime that we do a trade, we need to start off with our motivation. What's the reason we're doing it, and what's our forecast? What do we think the underlying is going to do? What about volatility? So we need to ask ourselves those two questions before we're going to do something. And that, I want to segue into this next section. That is going to help us decide, do we want to buy or sell options? Dan, you were saying, for example, maybe we are looking to buy ourselves more time. Maybe we're looking to spend a little bit of money. Joe, I know you were saying that in periods of high volatility, maybe selling is the better way to go. So, Joe, let's get back to you. What determines, or what do you guys, you and Dan, use to determine whether or not you want to hedge, right? We're all talking about hedging here. Do you want to hedge with long or short options? What makes that determination for you?
I mean, yeah, I think you just hit the nail on the head. Basically, it's where we are in the volatility regime, right? I mean, it's so I like to look at kind of current implied volatility versus historical volatility. And of course, we got a couple things going on right now in the market. Not only do we have a pretty substantial pullback, but we're also in earnings season, right? So at this point, you're going to see elevated implied volatility because you got two things, right? You got to pull back, and then with earnings season, that creates a lot of indecision with the option traders because basically they don't know what the earnings are going to be. That's a binary event, right? Either, you've seen plenty of cases just in this earnings season alone where earnings number was met. Sometimes even the revenue number was met. But maybe the forecast going forward wasn't as rosy as what was hoped, and they're punishing the stock. And so if you're going into that and you're seeing implied volatility tick up, and up, and you're looking and you're seeing, one of the things I like to look at is the straddle price. And so basically if I'm looking at the straddle price, that's going to kind of give me an indication on what the expectations are for the move from, the current date to the expiration or that expiration month. So let's say, we got expiration tomorrow for the October 26th weekly options. And, if you're looking at a straddle price on something, like you said, like a Netflix or an Amazon, Amazon had earnings after the close, and I'm not sure what the straddle was on Amazon, but it's down $158. So I'm, that's basically 9% move. So if you went in there expecting, right, if the straddle price was, say, expecting a 5% move in one day, well, then that straddle was cheap. Now, I know it's all hindsight's, 2020, but basically one of the things that I would look at, especially during this earnings season, what's happened the last couple times that we've seen the earnings. And you can look at this on a relative value or relative basis and say, well, Amazon, the move, back in July, we saw the stock go from 18.14 all the way up to basically 18.75, right? So you saw a $60 move. Okay, a $60 move, that was basically a 4% move in the shares. Okay, so now that's not the only thing I'd be looking at. I'd also be looking at some of the other earnings moves as well too. But if I'm able to kind of make a prediction, right, use my hypothesis, and I say that, well, the last couple times that we've been in this area, we've seen 5 or 6% moves, and the straddle's trading 5 or 6%, well, then it's probably fairly priced. Now, what happened today? Well, basically what happened today is there was some news that came out that people weren't expecting. And with that news that they weren't expecting, they flushed this thing down 9%. And so if you're going into this announcement and you believe that the current pricing of the options is cheap relative to where you think it might go, well then buying a put, even though it might seem a little expensive, it still might pay itself off because you might get that move. Now, if you're going in there and let's say, you're looking at a straddle price that is expecting a 10% move and you're saying, okay, well, based upon the last couple moves that we've seen, 10% seems a little overvalued, then I would probably be selling calls going into that, selling an in-the-money call or an at-the-money call. You want to get the biggest bang for your buck, you sell the at-the-moneys because that's where basically all that vega is tied up in, all that, the volatility exposure is tied up in those at-the-money options. So that's kind of how I would be making my determination is I'm looking at the current implied volatility relative to the historical volatility and say, okay, I don't know what exactly is going to happen, right? It's a binary event when you're talking about earnings. But even if it's not earnings, if the expectations, if I'm looking at my current implied volatility and it's way higher than what the historical volatility is, well, more than likely that's going to be mean reverting. More than likely that's going to be kind of heading back to an average. And so if it's really high, I probably sell calls. If it's pretty darn low, then I would be buying puts. I hope that makes sense.
It certainly does. Dan, how about you?
So mainly the question would be, I see what Joe was talking about. Would it be how we perceive the volatilities, or how would you word the question? I just want to, so I don't go off on a rant. How would you word the question?
Well, I guess the idea is, as the investor, we're talking about, look, something needs to be done. I'm worried about what's on the horizon. How do I know if, for example, I want to buy a put or if I want to sell a call? What are the warning signs that I should look for? What's a rule of thumb that I should be working with? What criteria should help me decide whether or not I want to put more money into the trade or if I want to take some money out?
Okay, and so maybe if we get it like buying a call or put, I agree with Joe that, and I think people need to get used to volatility. I'll go to the grocery store for my wife, and I'll buy the blueberries or the strawberries a pint. And my wife's convinced that when I come home, she'll say, do you realize you paid the top of the 3-year range of blueberries? I go, come on, honey, you always say that. She knows the range of the blueberries for the last 3 years in strawberries, and she's convinced I do it on purpose, that I buy this. And I tell her I don't. I just have a good habit of it. But it's the same thing here. If you buy a call, like right now, and you buy a 30-day call in the SPX, you're going to be paying a lot more than 3 months ago you would have paid for a 30-day call. So A, implied volatility is just some metric that kind of puts a measurement on on what you're paying, but it means nothing until you look like Joe mentioned historically and say, okay, historically, what is the implied volatility in SPX? And if it's closer to a 12 or 13 and you paid 18, you overpaid. And so if I want to get long in today's market, if I want to get long, instead of getting long by buying a call, because I look historically, I'm paying up, right, for this call. I may want to try to buy a call vertical debit spread where I'm selling an option against the one I'm buying. So I think understanding volatility is crucial for the retail investor. But one other thing is I look at implied, to me it's two different ball games. If you look at like the implied volatilities in the indexes right now, SPX or SPY or what, they're high for one stinking reason. The market's got smashed, and we're getting a lot of volatility. But particularly, we've gone down, and that's what raises the volatility. In a lot of these stocks that have earnings coming up, that's a different ballgame. And so to me, I'm much more careful playing in there because if I sell high volatility in the indexes and it's hedged, we could do some gaps, but generally, if it moves against me, I can be able to adjust it for the most part. Here's a problem when the volatilities are high in, let's say, Amazon or a stock with earnings coming up. I don't look at it the same. I look at it as totally speculative because it's all based on, as Joe mentioned, it's all based on expectations. There could be a call with 2 days to go that's 200 points out of the money that's traded for $5 because of past earnings. It can move a lot. So I want to be more careful when I'm selling options in these stocks that have earnings coming up because here's the biggest problem. I can't adjust it till it opens. I can't call Mr. Amazon now and say, hey, I sold some puts way out of the money. I had good probabilities, but hey, I was just joking. We're down 140 points. It says I'm going to lose 10 grand. Can you let me out? You won't get that phone call. He won't answer you. I stinking guarantee you. So in stocks, the biggest problem is for earnings, you really can't trade Amazon until it opens tomorrow. And by then, in some cases, it could be too late. So it's that gap risk, which makes me more nervous on selling options for earnings. Yes, the volatilities are high, and if it works in expectations, but you generally don't see those kind of crazy gaps in the indexes as you do for earnings. Anyways.
Okay. Certainly that makes sense. Now, guys, we're at our hour. We're actually a little bit over, but before I wrap things up, I want each of you to take a minute, if you would, please. We just talked about earnings. What are some other market signals that you look at, some different things that you pay attention that might raise a red flag where you just say, hey, you know what, I don't like the looks of this. I might want to look at protecting my position for whatever reason. Joe, let's start with you. 60 seconds, please.
So when I was on the floor, there used to always be the saying that there's a lot of charts at the bottom of the ocean. So I wasn't really much of a technician, but I have become more of a technician as I've gotten a little bit older, and not necessarily because I truly adhere to everything that the charts say, but I realize that the market is psychologically based to a certain extent. There's a lot of market psychology, and if everybody's looking at the same indicator, well, then it becomes a bit of a forward moving average, and it becomes a bit of a recurring theme that if everybody's doing the same thing, it's going to have an effect. Now, I look at that as I'd say if we're moving below certain averages, and that even if I think that there's value at that average, and where I say, okay, the stock's cheap at this point, I might, and I see it going through that, maybe I give myself a little bit more room if I'm looking to sell some puts like into that volatile move. I don't mind buying things, and I'm not going to try catch a falling knife. I'm not going to try to draw my line in the sand. But I'm also a little bit more aware of some of the technicals now than I was when I was on the floor. So those are some of the things that I spend a little bit of time looking at besides just straddle prices and volatility indicators.
Okay. Dan, what about you? Anything specific that you keep an eye out for?
Yeah, a couple things. Do you have a plan? Do you have a plan before you trade? How are you setting up the trade? What's your profit target and max loss? When you're going to adjust? How you would adjust? Have a plan.
Okay. Well, guys, I really thank you very, very much for joining us. And unfortunately, I've got the red light flashing saying that we are absolutely out of time now. So, again, thank you for taking time out of your day, joining us. Great information that you've given us to think about. And ladies and gentlemen, we hope to see you next time. Have a great day.
Investors should know that options involve risk and are not suitable for all investors. You should not enter into an options transaction until you have read and understood the risk disclosure document, characteristics and risks of standardized options. This brochure is available by visiting www.optionseducation.org or by calling 1-888-OPTIONS. OIC makes no recommendation with respect to any financial firm. OIC does not make any warranty as to the accuracy, usefulness, timeliness, or the continued availability or existence of information created or maintained by others. Multiple leg strategies involve multiple commission charges. Opinions and strategies expressed by others are not necessarily those of OIC, nor does OIC endorse, warrant, or guarantee products, services, or information described or offered by such firms. Commissions, fees, margins, interest, and taxes have not been included in any of the examples used in this show. These costs impact the outcome of all stock and options transactions. Consult your tax advisor about any potential consequences. None of the information presented in this show should be construed as a recommendation to buy or sell a security or to provide investment advice. You've been listening to the Options Industry Council's Wide World of Options. If you have questions about anything you heard on today's show, email Joe Burgoyne at options@theocc.com. Or you can call OIC's Investor Services at 1-888-OPTIONS. Interested in connecting with OIC on social media? Like the OIC page on Facebook. Follow them on Twitter at options_edu. Or join their group on LinkedIn. Thanks for listening, and be sure to check out our next episode of the Wide World of Options.
The preceding program was a production of the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/The Options Insider, or via questions@theoptionsinsider.com.